Hello, let's go over this week's data. Only an idiot tries to time the market, say my two buddies here, and I'm with Bender here. They claim to have never met a successful market timer. Well, they don't get out much, do they? Renaissance Technologies is one of the most successful hedge funds in the world. Its medallion funds generated roughly 66% annualized returns. That's before they paid themselves. From 1988 clear through to 2020 when they did this last report. Their maximum drawdown at the end of each of these years was zero. I'm sure they had some drawdown during the year, but it's not recorded where we can get our hands on it. But going year to year, they never had a losing year. This is done with no financial analysis. It's all math. They look at the price of each stock and they look for patterns with other stocks or with volatility or with mean reversion, whatever they come up with, it's all math. They don't know anything about the company that they invest in. It's totally driven by information on price. If I stick Medallion Fund on my normal chart, here's Medallion at 66 and at no year where they had any losing, it's just it crushes everything to nothing. So that's what a market timer really looked like, if you're really king of the hill. Warren Buffett once said that it's wise for investors to be fearful when others are greedy and to be greedy only when others are fearful. And so does he attempt to amass cash at market tops so he can buy at a bottom? Oh, he absolutely does. If you follow his buying and selling, he does this all the time. He's not a buy and hold purist like he wants us to be. He's in and out whenever he feels like it. In fact, they even have an indicator named after him. It's the U.S. Buffett indicator. And it's the stock market, the total U.S. stock market value divided by the annualized GDP of the country. So right now we have 54 trillion market value and 28 trillion GDP. The ratio is 193%. So that's right at that point there. So here's a zero deviations historical trend line. So that'll be a linear regression. Then plus one standard deviation, plus two standard deviations, minus one standard deviation, minus two standard deviations. And so as the indicator is climbing, I'm sure they just let her go, but the minute it starts to come down, they'll sell a certain percentage of every stock and get cash. But then if it starts to go back again, they'll jump back in the market. And then when it's dropping, that's when they're selling and accumulating cash, and they wait until it is bottomed out and started back up again. Then they start buying like crazy. Whoops, we'll sell again. We just passed another trigger point. We'll go ahead and buy now. Buy like crazy. We're okay. Sell a little bit. Buy again. So just using his own indicator, he can be doing a lot of buying and selling based on what he thinks the market is. And so he's market timing all the time. He just doesn't call it market timing. But when he claims that he never looks at the market when he makes a decision to buy a stock, that's not true at all. If you look at his history, you can tell that he's looking at his way of saying the market is overbought or oversold. And just to remind everybody of how clever our little formula is, Now we'll go back and we're looking since 2006. There's the total return of the S&P, the bond ETF, and I get the Yahoo data to include dividends so that it is a point here with dividends. And the 60/40, and it's also called the Target 20/30 by a lot of companies, but 60/40 is what your typical advisor will have you at. And yeah, it's slightly better than cash and the S&P. Here's the Berkshire Hathaway fund. Yeah, it's a little bit better than the S&P, and that's admirable, but it's not outrageously good. In fact, if we look at some terrible, terrible things to do and say, well, let me just time it. Here's a 200 moving average on the S&P, and here's the 200-day moving average on the NASDAQ. Now, there's plenty of NASDAQ stocks in Berkshire Hathaway. Don't kid yourself. He's not just picking the big, slow-moving companies at all. He's doing his best to get those companies that are going to go outrageously high. So it's a good thing to say, let's just do the QQQ and do the simple 200-day moving average buying and selling. You'll get a return that's better than Berkshire Hathaway. And he was only able to cut down the risk from 55 down to 51. He didn't do anything. He cut the risk an eensy bit and he made an eensy bit more money. And we're supposed to give this guy what? When what he says goes? He would be beat by any simple 200-day moving average. And you get more clever with a VIX formula or an ATR formula, or just jump and use the QQQ, and you've got it way better than what he's talking about. So we're still saying the crash is starting. Mostly cash. I've got a little bit of gold and gold miners, junior gold miners. I was looking for other important folks that might say the same thing and say, hey, we got a crash going. And the thing that hopped out on Zero Hedge more than anything else was big headline. Robert Kiyosaki warns the S&P to fall 70% in the biggest crash in history. He said that February 12th this year. And when you read the detail, he says that'll probably happen in October. I said, oh, well, okay. So Big Shot says there's a crash coming in October, but I don't know about this guy. Yeah, he wrote a book, Rich Dad, Poor Dad, back in 1997. He gets asked his opinion all the time. He gives his opinion all the time. He amasses all kinds of money, he claims. But he's terrible at guessing what's going to happen with the market. He's been wrong 8 out of 8 times since 2009 on predicting a crash. He predicts in the wrong times. And I've blown this area up here to show something important here. All right. The crash had been there. We were actually recovering from a crash right at this point here when he says in August 17th, 2020, hey, the crash is only beginning. Just stay out of this market. We're dead meat if we stay in. And he repeats it again here. Well, now I don't know why we're still going up, but boy, get out. There's a crash coming. Now, at the same time, I went back in our newsletter and I found the newsletter I sent out on 4/11/2020. 4/11, it says we go back in, but only if you can stand a little bit of volatility. Yeah, if you can't, I'm not worried if you stay cash, but if you are quick on your toes, I'd say let's go back in. So we have our signal, took us out here, brought us back in right there. Well, that was I think we hopped out right about in here. Well, that was pretty good timing on a serious crash. Way better than his timing. And we haven't had the crash yet, but now he's calling another crash. Okay, so maybe I'll agree with him this time. Now, a long time ago, he said he never liked cash. He says when we went off the gold standard under Nixon, that was the end of it. Of course, he's not the only guy that says this, so he's not that clever as to come up with anything new. He just jumped on the bandwagon. He says, cash, don't save cash. What you do, save gold and silver. And he claims he converts all his earnings from books, from lectures, into silver and gold. This strategy, according to Kiyosaki, has led to an accumulation of $1.2 billion in debt, an amount he admits to. Well, how can you run into that much debt? I don't think an honest fellow can actually do that. This sounds like Billy Saul Estes to me. How can you go to the bank with a pile of gold and get them to loan more money than the gold is worth? He knows a banker that I don't know, because the banker would say, "What's your collateral?" "Oh, I got 50 pounds of gold." "Well, here's what gold is today. I'm not even gonna give you that much. I'll give you 80% of that," or something like that. Somehow he's convinced people to continue to give him money, and then he blows the money, and nobody wakes up until he's 1.2 billion in debt. In addition to that, the man's lying, even with the worst of luck, buying gold and silver just at the peaks. If you really hung on to him like he says, well, the price now is higher than it's ever been in history. So your assets of gold and silver would be worth money. So you couldn't be in debt on that unless you're somehow using it to flim flam the banks, or you're just flat out lying. You don't Unless you had 2 billion in assets, you wouldn't have 1.2 billion in debt. And if I count up all he's not making as much as ex-presidents on speaking tours, so no way he has a billion assets. I think I got to write him off as just another in a long line of jerks. Sorry. In our timer from 2006, we're on sell. We have sold. You see that we sold on 422. At the time, we had nosed over and dropped back down to where it's only up 60%. But if you followed the signals, you'd be up 60% from our last time we went in. Now we see that our timer has clicked up and given us a sell. That's why we went cash, except I have a little bit of gold. VIX is coming back down though. So in the next couple of days, if it continues to come down, we should see a turnaround on the VIX and be getting back in the market before long. This is our 60/40 long and short volatility, the green line, and it's nosed down a little bit, but then starting to come back. And silver and gold line is still coming up, so they don't look too bad right now. A little bit different chart than we've had in the past. You read this by here's what the typical 401ks have in them. You go find what you have. If it's not on here, send me an email and I'll get it on there. So those that were in VIGAX, now you are 100% cash, so forth, so on. OIEJX, you're still 100% because it has been producing money through its interest-bearing stocks. Not too bad. And you sold your PGOEX if you're in market with that. You don't have anything everything but your commodity, 100% commodity right now, and you should be doing just fine. Here's what they look like over the last 3 months. The commodities are doing fine. There is one fund that is actually really screaming. It follows the QQQ quite accurately, and that's the FBGKX fund. It's jumped back up in the last week. All these funds have jumped the last week. So if the volatility drops, we'll be back in the market with everybody pretty soon. We hope. When we went out of the market, here's the 22nd when we went out. Yes, QQQ and S&P have come up a little bit since then. Gold's been stable, but junior gold miners have really had a big jump. And so that's kept me going during the time I don't have my QQQ going. So we're at a 50% buy with the ATR percent sell and the 200-day still buy, but we sold because of the deterioration we were looking at. After a week, everything's flat. Two are a buy signal still. Everything's flat. We continue with the existing signal, but if they all start to turn up, that'll help us make up our mind. Then you look at our overriding signal. We went cash. It's still climbing. This may take another week before it turns and comes back down. Typically, when we come out of a market crash, we get a turnaround on the 200-day percent stocks as being faster to come back in the market than our volatility. And if all three of them start to pop up, we'll be coming back in the market. Thank you. We'll see you next week.